Look at a map of the world today. The divide between wealth and poverty is staggering. The Solow-Swan model attempts to decode exactly why economies grow, and more importantly, whether that gap will ever close. A fundamental question in macroeconomic theory is whether trailing nations will naturally catch up to developed ones. Imagine two runners on a track. If one starts a mile behind, do they inherently run faster just to close the distance?
This brings us to a controversial theory known as absolute convergence. It is a bold, uncompromising claim about the destiny of global economies.
The hypothesis is straightforward. Absolute convergence states that impoverished nations will experience more rapid economic growth than wealthy ones, theoretically regardless of their underlying structural characteristics. It imagines a world where the sheer lack of capital inherently drives accelerated growth. Because rich nations already have abundant capital, every new factory adds less value due to diminishing returns. Conversely, in a poor nation with very little capital, a single new factory creates a massive spike in productivity. For instance, giving a tractor to a farmer who only has a shovel yields a much higher return than giving a second tractor to a farmer who already has one.
Historically, absolute convergence seemed unverified across broad global datasets because countries have vastly different structural realities. However, it was empirically verified among groups of structurally similar economies, such as OECD countries or individual U.S. states. While data from the mid-1990s to the late 2010s demonstrated a robust trend of global unconditional convergence, recent economic data post-2020 indicates this trend has starkly reversed. Following the global pandemic and subsequent economic shocks, macroeconomic divergence has reemerged, with many of the poorest nations once again falling behind advanced economies.
This brings us to conditional convergence. Countries with different structural foundations converge to entirely different steady states. Once there, their per capita income growth rates stabilize. But here is the critical mathematical distinction. While the relative wealth gap, meaning the percentage ratio between the two economies, remains constant, both are now growing at the same rate. Consequently, the absolute wealth gap, the actual dollar difference in per capita income, will continue to widen indefinitely.